Welcome, everyone, to this Friday edition of Mango Spaces on the 13th of December. We're going to cover something that over the next hour that we usually don't cover, at least not in precise detail on these spaces, but it's nonetheless one that I think in some way we have either interacted with it either as a business owner or as a consumer, for example. The question of competition law and answering that question of what constitutes fair treatment in the marketplace and why does it constitute fair treatment in the marketplace and who's ultimately going to decide that, on what basis is that decided. It's an interesting and very expansive area of not just business and economics, but also law as well. And in this part of the world, these sort of things are taken care of by the Competition Authority of Kenya, which has the initials of CAK, not to be confused with the other regulatory agency, the Communications Authority, but they will be telling you all about themselves in just a moment. We're very glad to be joined tonight by Dr. Adano Wario, who's Director of Policy and Research at the Competition Authority of Kenya. We also have Mugambi Mutegi, who once upon a time was a journalist on this side of the fence, and then he crossed over and decided that he wants to do policy communications instead. We often give him a bit of grief on these things on this side of the fence, but he's a good sport about it. So I'm going to start with him first and foremost. Mugambi, you've been on our side of the fence, right? And now you've crossed over. Now you're handling policy communications. If you were to explain to, say, a trader in Mombasa, what is CAK? What does it matter? What's the importance of it? What would you tell them?
Thanks, Amar, for the introduction. Yes, it's been 6 years of policy communication. So far, so good about self-assess. Now, in terms of communicating, I think it all depends with who you're communicating to. I'm seeing Mugambi Nandi is here. If I were to have a session with advocates like himself, it would be much more high level. So what we've seen in our experience is that when you go to the market, majority of the people are consumers. All of us are consumers, whether you're in the upper quintile of income or in the lower one. So you'll find that it's easier to communicate to the common wananchi, as we commonly call them, about consumer protection. So I'll begin with that. In terms of our mandate, we have a dual mandate. Consumer protection is one of them. And here we just look at things to do with misrepresentation. For instance, a trader or a business owner lies to you, or basically misrepresents. That's a fancy way of saying lies to you. It's misrepresenting the facts. So, for instance, they could be telling you that this product has this certain quality, this television set will do 1, 2, 3, 4 things, only for you to purchase it, go home, and what was marketed to you is not the case on the ground, so to speak. Again, it could be someone selling to you a loan or a financial product, and they deceive you or fail to give you full information regarding the penalties applicable, the interest rates, how long this loan tenure will be. Then at the end of it all, after 2 years, 3 years, they still claim you owe them money. So consumer protection has that. There's unconscionable conduct within there where someone who was a more powerful business owner or proprietor infringes the rights of a consumer because of their powerful position. So that is what sells CAK most of the time, especially to the general public. But now when you go to more technical stuff, as discussing today, then you'll separate it into two main issues. So there's market conduct and there's market structure. So everything else falls within that. I'll start with the most common, it's anti-competitive practices. And Dr. Adano will speak to some of these issues later. But here, the common things you'll hear is abuse of dominance, price fixing, market allocation. The first two, I think, are more or less self-explanatory. Here you find competitors, instead of competing on the merits for consumers, innovate, come up with new products to reduce the cost of your goods or services. They decide, it's easier and much more profitable if we just fix the price and not compete so much. So abuse of dominance, here you have a player who's 50 plus in terms of market share, using that position to injure the consumers or even kick out potential competitors, then jack up the prices later. Market allocation, here you have competitors instead of just going to the market and looking for customers, then they'll segment and say, we do this, sell in Nairobi County, I'll never come there and disturb your peace, and I'll sell in Western or I'll sell such, allocating, and it can be smaller than counties, it can be even within one county, you can find players saying, you just stay on this side of the road, I'll stay on this side and let peace prevail. So you'll find being called restrictive trade practices and competitive practices. So you'll hear a lot of that from Dr. Adano. There are instances intervened. Steel matter, I think last year, penalized around 14 companies, steel companies for cartel conduct. Prior to that, this was over $500 million in terms of total penalty. The paints sector, again, the cartel there was around 60 million. That was a few years back, 4 or 5 years back. So that's more or less uncompetitive conduct. I've already covered consumer protection. So there are two more key technical areas remaining: mergers and acquisitions. In terms of competition law, when two or three players decide to merge for whatever reason, it could be for efficiencies, someone could be selling out and exiting the market for whatever reason it is. So once that happens, once you reach a certain threshold, you're supposed to the authority to lodge the matter with us. Then we'll assess how that transaction, once the merger is approved or is implemented, how it will potentially affect competition in that specific sector. Then we also look at other public interest concerns, which again is tied to the topic today. We look at things like how will it affect SMEs, or how will it affect employment? This transaction, if we don't approve it, will it have a huge detrimental impact on the economy or a very important part of the economy? So that's some of the things we look at. But two-pronged, we looked at competition concerns after the merger, and we look at public interest concerns after the merger. And the last one is something I think that has been in the press or in the limelight quite a bit since we started the department a few years back: abuse of buyer power. It's not the same as abuse of dominance, but in this case, you'd find there's someone or a business entity that holds a certain infrastructure that is extremely key. So we'll call this person the buyer. So it could be, for lack of a better example, in the retail sector, where you have a supermarket that has a pretty good network in the country, and then they have suppliers who sell products to them for onward retail. So the supermarket in this instance is the buyer. The supplier, the person selling the goods to them is the supplier. So there's a buyer-supplier relationship. And so that they don't perpetuate this thinking that buyer power is retail oriented only. A similar case could be in the insurance sector, where you have 5-6 big insurance firms who are the buyers in this case. Then we have suppliers to them, the garage owners, the motor vehicle assessors. So there's a buyer-supplier relationship in there, similar to the example I've given in the retail sector. So what would happen for it to be abuse is where when they come to negotiate on the table, one has a bigger or strong position. So if you abuse that position by threatening to terminate contracts, declining to accept goods, you order them and they're delivered. So CAK intervenes in those areas. So there are 4 technical departments: buyer power, mergers and acquisitions, enforcement and compliance that deals with uncompetitive practices. And lastly, we have the one I started with, consumer protection, that, yes, just enhances the welfare of the Kenyan consumer. Lastly, before I cede the floor, we are a government agency. We've been around since 2011. We are domiciled under the Treasury. We are at CBK Pension Towers, 15th floor to 18th floor. Thank you.
And that certainly helps, because I'm sure that a little later on in the course of the conversation, there are probably people who might listen to this, if not now at the moment, but later on, and they'll be like, okay, there's something that I have here that I think I would like to bring to the attention of CAK, or I think I need to bring it to CAK as a matter of consumer protection, and therefore they're going to want your contacts at some point. But we'll get to that later on towards the end. Dr. Rio, the work that you guys have done is pretty interesting, and I want to use one of the more recent determinations that CAK had against Mogo, for example, in terms of trying to figure out exactly where CAK stands, especially in an environment where you've got regulators that may be perceived to have overlapping mandates, or actually do have overlapping mandates, because this essentially is a financial services firm. And then you've got, in public side rather, an entity like the Central Bank of Kenya, which is essentially like the apex regulator of financial services. In those sort of situations between these two regulators, how do you decide who's taking on what sort of cases?
Thank you very much, Rama, for having us. And I think it's important to just spell out the fact that, yes, we are a national regulator compared to Central Bank of Kenya, which is a regulator for financial sector. As Mugambi mentioned, the authority has dual mandate in terms of competition enforcement and also consumer protection. And that allows us to look at issues that affect consumers in a wider meaning of the word of consumer welfare. The Mugo matter falls within the financial sector, more particularly in the digital lending space, where 3 complainants brought their complaint to us based on the loan that they have secured from Mugo. There are a number of issues that they brought to us under consumer protection mandate of the authority. One is the fact that the loan that they agreed with Mogo were for an extended period of time, and therefore the Mogo did not comply with those terms in terms of them speedily repaying some of the loan, and therefore they are able to complete their loan payments. But the Mogo objected to that provision, which was in the contractual arrangement at the time of disbursing the loan. And the second matter, which also relates to consumer issues with regard to interest rates and the charging, of the interest rates. According to Mogo, the loans were disbursed and also according to the complainant in Kenya shillings. And that's the time when the Kenya shilling was depreciating against the strong currency like the US dollar. And at that time, because of instability of currency exchange, Mogo decided to charge some of those loans using the dollar. And therefore, there was issue of unilateral change of contractual terms and payments in different currencies. In this case, the Kenya shilling was the loan disbursement currency, whereas Mogo opted to charge consumers in US dollars for the repayment of the loans.
And as I understand it, they had not disclosed any of this upfront to the client, had they?
That's right. And that's also links to what Mugambi mentioned with regard to misleading conduct in the market. And therefore, two of them, one is misleading of disbursement of the loan and the terms and the condition therein to the borrowers. And the other matter is the fact that Mugo was making this decision unilaterally without involving the complainants. And therefore, this was a consumer case that is within the financial sector. And also the fact that central bank is strongly on financial regulation of the sector, whereas our primary mandate is consumer protection issues. And therefore, we're able to remedy the complaint. And I would also like to point out that we also do have memorandum of understanding between the financial sector regulator and ourselves. And that allows us to also look at consumer complaint issues in a mutually beneficial way to the borrowers in this case.
All right. So just to be clear, because I know the next question that some of the people on this space will ask is if they have an issue with their bank with respect to improper disclosure, for example, or variation of terms outside of the scope of the contract that they sign with whatever bank they're in, should they come to you first or should they go directly to the central bank? And granted, I know that's a bit of a hypothetical situation, but those are the sort of things that I guess consumers will be asking.
Yes, I think that's what happens. And consumers are at liberty to choose whom they want to take their complaint to because we have both mandate, but our mandate on consumer issues is stronger and therefore they can bring to us and we can look at it addressed under the Competition Act. And the consumer welfare issues are key in that space. However, there are also instances where issues of digital credit and complaints or even licensing issues are being brought to us. And because of memorandum of understanding between us and the bank, we have been able to refer those cases to them. So referral in this instance is also possible. And however, if a complaint is brought to us and there's provision within the competition law, we'll be able to address and remedy that complaint without referring to the bank.
And just for the listeners on this particular space, if you'd like to essentially read that full determination from the competition authority, it's a fairly short, straightforward 3-page document, which essentially linked it to the tweets directly under the space on the Mwango Capital account. Dr. Orio, with respect to enforcement, understandably, we're in an environment where trust in public authorities at the moment has been significantly eroded, especially over the last 2 or 3 years. What are the challenges that you're facing in enforcing compliance, especially given the fact that if we look at our court system at the moment, the backlog of cases there just continues to go up year after year? I believe that off the top of my head, the backlog now is well over 300,000, 400,000 cases. So what challenges are you facing in trying to enforce the decisions that you have in mind?
That's a very good question in terms of the primary mandate of the authority in terms of enforcement of competition. There are a number of challenges, though, that we face in terms of ensuring compliance. Our objective primarily is to advocate for competition and consumer protection issues. One of the issues that we look at in terms of speedy disbursement of complaints or enforcement is to prioritize our activities on an annual basis based on sectors that we think are priority to the authority, and also they are likely to have anti-competitive cases to the wider population. In terms of prioritizing our activities, we look at the timeline it's taken for us to resolve any complaint. And our objective in compliance enforcement is also to be as much as possible and over time be predictable in our decisions. The approaches we use in this instance is advocacy, reaching out to different sector players, stakeholders that we think there are concerns in that particular sector, and therefore that requires information about competition and therefore compliance with the Competition Act. The way we do this is also in collaboration with other agencies, other sector regulators and other government agencies. We do it in 2 ways. One, we organize for a joint training or sensitization program where we structure our program in this instance and inform the stakeholders the provision and the requirement of the law, and non-compliance will carry penalty. And therefore, that's how we approach compliance in this case. And the other option is we have engagement and collaboration with associations, may it be consumer association or sector-specific association. And therefore, we request for sensitizing those sectors on competition issues and consumer welfare, and also including buyer power issues. And over the years, we have done a number of sensitization programs, educating the public and our stakeholders, those issues that are important to us, particularly issues around price fixing, if there are issues like that, or if there are potential collusive behavior in the sectors, or if there are particular concern about penalty cases that we have issued because of cartel cases, for example. Then at the tail end of that kind of intervention, we also propose to train the employees who are the main individuals behind implementation or operation of those companies. And that allows us to inform the public and also stakeholders that provision with the Competition Act is crucial, and therefore compliance is a softer approach to competition enforcement. And also it's much cheaper as opposed to enforcing dominant firm or a cartel cases or price fixing cases, which is much more expensive, both in terms of our operation and also the entities that we are pursuing in this case.
So in short, you're essentially going to the public and saying, look, these are the rules. You need to be aware of them. And it's cheaper for you to comply rather than us having to deal with cases 3, 4, 5 years down the line.
Yes, absolutely. Our thinking is that the more people know about the provision of the law, the more they are likely to comply with. Because there are instances, even though there could be ignorance and there could be lack of understanding of competition law, when they understand the law itself, then it's much easier and cheaper for us to engage. And also we have seen instances where big companies with several employees and large operation across the country have also by their own volition and because of understanding what we do or they wanting to know what we do, they have approached us to educate or sensitize their employees. And that has actually bear fruit in many cases where we have a very close mutual relationship in terms of how the law operates and how companies comply with the provision of Competition Act 2010.
Just going back to that question that you posed there with respect to people may not actually understand the law and whether or not it actually applies to them and so on and so forth. And I can think of a few instances where companies have essentially executed a merger of some sort. And then we see an announcement coming through from CAK saying, look, we find these specific parties because they went in and contravened the Competition Act, because they executed this merger and they did not come to us as part of the process of getting approval for this. If any two companies are thinking about an acquisition or a merger, at what point do they need to come and get a no objection from CAK?
That understanding will involve mergers and acquisition cases. And normally parties need to notify any proposed merger to the authority. And there are different ways of looking at merger cases. One is there exist merger thresholds, which allows companies to either notify us and continue with their merger, or those companies which are above the threshold required, they need to notify us. What happens in this case is that before the execution of the merger, they need to understand the thresholds. And also once we have identified the companies have merged or they are proposing to merge or they have implemented merger, their nature of operation also matters. There are many companies which are not only domiciled in Kenya, but they are also domiciled elsewhere across the globe. And therefore they are multinationals and the similar competition rules exist in those jurisdictions. And therefore, when we get attention of such merger which has been notified without our approval, then the first call will be for them to supply to us the documentation and also for them to bring to our attention the understanding under which they have done that. And in this process, it's not only merger threshold that is important for them to be analyzed and also action to be taken. Their cooperation in that process is extremely important for us to look at what are the circumstances, what are the issues around competition issues, and also the fact that most of these merger notifications are handled by company laws. And one of our key stakeholders in this process are also law firms who are presenting these companies. And therefore, all these factors put together allows us to make a good assessment of the circumstances under which this merger was executed And therefore, that allows us in a more objective way to assess and issue a remedial position based on the thresholds for the merger and also other considerations like cooperation and also their nature of operation, if they are multinational, if they are small companies in Kenya alone. So all these
Right.
issues allows us to execute it.
Let me flip the question around, because this is one of the questions that, especially for those of us who are not lawyers and we don't study these things in detail, will inevitably ask. The question will be, hang on, if two companies have chosen of their own volition, right, to either be sold or to acquire each other or merge or whatever the case might be, why is it that they need to notify the regulator? In other words, what is a problem we're trying to cure from a public policy perspective by having that notification process baked into law?
That's a very important question when we look at mergers and acquisition within the competition law. The important thing is mergers an avenue of companies to expand their capital and enjoy economies of scale. And also there could be different type of mergers. May it be companies at the same level of operation, may it be companies which are vertically integrated, or could it be companies which are not related in their operations, both in terms of services or products. The issue which is important and why merger should be notified with authority is the competition effect that might arise post-merger. The analysis of merger notification to the authority will be carried out having in mind that not only the two entities or three entities that are merging, that the decision of their board of directors or trustees is important first and foremost, that they will have a discussion individually and also between themselves. And those documentation have to be provided to the authority to show that the process is above board from their end as well. Now, once that is done and the merger notification is brought to us, then the analysis now will enable us to look at what are post-merger scenarios in terms of competition effect of the merged party. And that's why it's important in terms of market shares or market power of the parties. And therefore, once they have merged, what will be the scenario like post-merger? And therefore, will it be dominant? Will it be potentially upsetting the market? Will it be killing other rival companies? Therefore, the most important bit for merger analysis is to consider whether that merged party is going to lessen competition substantially, or what will that merger look like. And that's why, for the same reason, that the authority, upon the analysis and having been satisfied that the merger has no competition effect, then we go ahead and approve. Or if the merger has implication for competition post-merger, then we can allow conditional approval of the parties. So the most important thing basically with the merger analysis is post-merger scenario, how that will affect the other players in the market in terms of market power.
Mugambi, do you want to weigh in on this?
Yes, quickly, I'll just add to what my director said. I'll start with the threshold. I think it's global practice, best practice. The authority, CAK in this instance, is not really bothered with the benign mergers, because the reality is, if you know you're just a small kiosk merging with someone else, three guys whose turnovers are 1 million or 2 million, the probability of that transaction negatively affecting competition is minimal. So we are not really interested in that. Where we come in is where two or three parties, if you combine their turnover or assets, combined turnover of the merging parties or assets, whichever is higher, once you reach the 500 million mark, then you have to come to CAK. So if you reach the 500 M mark, you have to notify the authority. For instance, anything between 500 million and a billion, we give you an exclusion. We are not too concerned about it. We are concerned, but not too concerned. Just notify, we'll give you an exclusion typically in 2 weeks. That's our average, and you can proceed and merge. Now, if you cross the 1 billion mark, you have to pay some filing fees with us. Now, here's a combined asset or turnover. You have to pay some filing fees, and it's graduated all the way until over 50 billion combined assets or turnover, whichever is high. So the benign matters, we're not really interested. So there's a question quickly as I end, which you asked, why is the merger regulation baked into law? I would answer that question requesting you to think about the opposite scenario, where it's not, where companies just buy off each other at their pleasure. Yes, it's a free economy, but let's assume there are 3 or 4 entities in a very critical sector, and without reference to anybody, they just merge, become one big behemoth, a monopoly in this case. So they will not innovate.
So like building your Kenyan equivalent of Standard Oil from the ashes of all the subsidiary entities.
Sure. And I think there's a conversation about some peer companies that are merging this week and it's going to become the biggest peer company. In this case, there will be one or two entities that are not inclined to innovate, inclined to increase prices because you have no choice as a consumer. As Ramai, if you had three entities and you could pick whoever you want, now when they merge, competition is affected. So consumer welfare is also affected. So the whole thinking of antitrust law, which is another name for competition law, is that yes, the market should work. It's regulated for the market to work. Efficiencies for the business, economic growth, but also looking at the consumer who is the end beneficiary of all these competition law issues.
I want to get back to the question around inequality in the marketplace, competition inequality. And one of the interesting things about the case that you cited a little earlier, Dr. Rio, where 9 steel manufacturers were fined. And this is roughly, just to put it into context, we're talking about roughly $2.3 million in fines because they engaged in prohibited anti-competitive prices, including price fixing and output restriction. And those fines range, depending on the company we're talking about, from nearly 87 million shillings to around 9.2 million for another. Now, this is one example where if I am a consumer who's trying to build a house, as is so very often common with us in Kenya, you've poured your heart and soul into this, you leverage yourself to the hilt, you borrowed from the SACCO, probably using your credit card for some things. You're buying all these inputs. And at the end of the day, these input manufacturers, the steel manufacturers in this case, essentially are colluding to make it more expensive for you to be able to get the materials that you need. So this is one example, right, of exacerbating inequality, because if you're essentially fixing the price of a commodity at a specific point, you're essentially doing that to the exclusion of many other players in the market. Are there any other examples you can give us of how that sort of inequality plays out in the marketplace?
Yes, indeed. That's a very good example in terms of inequality related to competition. I would like to just point out competition is not the only way of looking at inequality or therefore consumer welfare. There are scenarios where competition can play a role and also contribute to remedying inequality. Competition analysis, or generally inequality analysis, has 3 categorizations. One is providing opportunity for the players. The second one is assessed based on income, which will be largely in terms of the outcome of the activities you mentioned, also under the steel sector. And the third one is the wealth, how wealth is created and how wealth plays out in terms of creating skewed distribution across the population. The most important categorization for competition will be through opportunity for access to market. And one of the things that we have done, which is similar to the example you stated with the steel, is in the agricultural sector, which is one of the important sector of our economy. And this is a tea farmer who wanted to enter the market. And one of the key variables for competition will be how can we limit barrier to entry into any of the sectors. This particular farmer, relatively small scale compared to other farmers, wanted to establish a tea factory at the specialty tea. The first step for him was to approach other tea factories. And the requirement at the time, although the Agricultural and Food Authority was the regulator and licensing farmers who are establishing a factory like of that nature, one of the requirements was consent by a tea factory before they allow the farmer to enter that market. And therefore, it became difficult for this particular farmer to enter that market because he did not have the consent of the players in the market, which is tea in this case. So a complaint was brought to the authority, and that complaint was analyzed, and we established that was restricting entry into the sector.
This is cartel-like behavior, isn't it? Because it's like, as coffee growers, for the sake of argument, will not allow a new processor who's not based in East Africa or who's a Kenyan to come into the Kenyan market, that sort of thing, right?
Exactly, that's it. Because tea grown in Kenya is regional. There are regions which grow tea, and not all regions are the same. And therefore, in this particular case, this farmer was located in one of the regions. And our attempt was to ensure that the regulator, which is a Food and Agriculture Authority, works with us to break out that kind of cartel among the tea factory, so that they allow this particular farmer to enter the market. And this allowed this particular farmer to enter the market and create more employment and also earn income for our economy, because most of the tea was actually exported. It's not for domestic production, but it was largely for foreign exchange earning by the government, and it's largely for export. So this was a very important sector to our economy. And therefore, that kind of consent requirement restricts entry. And what has happened as a result of that is there are many employees who are enabled to earn income and therefore contribute to their own livelihood and well-being. And two, the foreign exchange earning that was earned through the tea export also contributed to our economic growth at the national level. So this is another instance where we have seen that competition, looking at it from objective perspective, allows economy to grow and also reduces inequality among different players, particularly small scale farmers or suppliers who are trying to enter a specific market but are not able to do because of restrictive conditions given by other players in the market.
Let me flip that question around before I get to a couple of more questions that are coming up. What about situations where those restrictions on market entry are being put in place by the state? Say, again, hypothetically in the tea sector, what if we have a scenario where the state, say through the Food and Agriculture Act, says the only entities who will be allowed to process crop XYZ will be entities that are either majority owned by Kenyans or have a 30% shareholder by Kenyans and so on and so forth. And the reason I'm asking that is because in the context in which we're going into, especially into 2025, there's a lot of talk in policy circles around building national champions, making sure that if we have industries that we're trying to build up in specific country XYZ, then it's majority owned, right, by local shareholders. And in that sense, it could be seen as a sort of anti-competitive behavior. Or what's your take?
Yes, that's true. There are instances where markets are regulated by government. Our understanding more generally is that government has opportunity or has a decision to make in terms of how some of the market play. Is more important in all this scenario is in any government reform, there is underlying consideration, which is much broader than competition, that public interest considerations are put in place by government. The underlying interest might be the same, but the government agenda for reform is much broader in terms of public interest consideration. And therefore, based on those considerations, that's why we have some of the companies that exist today, they have monopoly state in the country because government has this agenda and reform agenda for that purpose, that these entities are going to deliver on a wider public interest consideration, which outweigh competition consideration. So those two have to be considered in most cases, that government agenda reforms consider public interest and therefore they are much wider issue. And if I may recall, for example, South Africa, in terms of democracy and post-apartheid, some of their competition provisions, very strict in terms of how the marginalized or disadvantaged Africans are actually, through the law, allowed on part of the capital or employment as per the provision of Competition Commission of South Africa. So that tells you that government reforms, to a large extent, included in the law, as we earlier mentioned, with public interest consideration, taking into account the context in which the competition law applies. So that's our thinking, that government has a right in certain instances under special circumstances to have wider public interest considerations compared to competition.
I want to expand this into the digital economy, but also let me start with the regional angle first, because looking at some of the work that CAK is doing with other competition bodies in the region, your colleagues in South Africa, the COMESA Competition Authority as well, there's all sorts of interesting things that you're all trying to deal with. And one of the more interesting ones, and this I believe actually came out in November in the African Competition Forum, and one of the things that has been a concern to competition authorities in different jurisdictions is the conduct of, say, firms that are effectively a de facto monopoly, like Google, for example, more than 90% market share for search, for example. And search advertising does account for a significant amount of activity, right, up and down the region. Now, as far as I know, and you could correct me on this, there's not been complaints or any investigations initiated against Google except in South Africa. But could you walk us through those concerns when you're sitting as a regulator here in Kenya, and then you're looking at these big tech giants, Google, Meta platforms, and so on and so forth, who we often see getting hit by fines for anti-competitive behavior, especially in the European Union. When you look at our markets, how do you deal with comparable problems as a regional grouping?
I think this is one of the things that we have been struggling with for some time now. The issue around fintechs and digital is an area of concern to our sister agencies within the region and the continent, and within the African Competition Network, as well as in our collaboration with COMESA Competition Commission. We have done a number of engagements in other sectors, including food sector, cement sector, and in 2022, if I'm not wrong, we also released a press statement that relate to digital issues. However, we have not handled serious complaints in the face of growing and rapid growth of digital and fintech within the region. One is that even if we look at the more recent development of competition protocol under the African Competition Protocol of SFTA framework, we have seen that there's provision in that particular law with regard to abuse of economic dependence, where many firms or intermediaries depend on these fintechs for them to provide products or going online for sales of products or even providing services. So this is one of the key considerations that has been implemented under the African Competition Framework. And COMESA itself has also amended its law to include this provision. Up until recently, we did have those provisions in our law. And therefore, for us to enforce and collaboratively execute the growth of digital platform and the inequalities they create in terms of provision of services and employment is the provision of the law. Yet we are much aware the digital shopping case judgment in Europe that is known to create inequality. And therefore there was a decision passed within European Union for these fintechs to also allow rival companies to take up some of the activities that they do. Now, from ourselves, in terms of what we do, is we have actually realized this. There are certain complaints, and the complaint has been on a smaller scale, but we have seen that there are certain observations that seems to signal these fintechs are taking space in our economies, and therefore there's need for us to consider provision of these digital platforms in our law. And as we speak, we have proposed amendments to the Competition Act, and this is one of the key amendments that we have proposed both for companies which have strategic market position, but relates to digital markets and digital platform, as well as those digital ecosystems which relate to this sort of supplier-buyer relationship that we mentioned, where certain companies have much stronger bargaining position as opposed to them competing with other digital providers. So these are some of the amendments we have taken. And these are aimed at remedying some of the gaps that we have seen in our law. And therefore, hopefully moving forward, we'll be able to address these issues. In addition, we have also carried out a market inquiry just to test what exists within our ecosystem, to look at food delivery and grocery on digital space. And this actually shows that we have to include issues of gatekeeper, where big companies are actually intermediary in terms of allowing SMEs, who are largest segment of our markets, to access or deliver products to their consumers. So as we speak, we have a proposed amendment to the Competition Act, and that will be considered within the course of next year for it to be implemented.
Do you have any specific timelines on when you'd like to see these amendments coming to law, and what bill should we be looking out for with respect to getting these amendments baked into the Competition Act?
Yes, there are specific timelines in lawmaking. And therefore, the first proposal in lawmaking will be for us to propose amendments that we think are important, and therefore the law indicates gaps in this process. The first step is for us to develop and also engage stakeholders. And participatory consultation, as you know, is provision within our constitution and it's a requirement. And we have passed through that stage. And the next step is for us to propose those amendments to our parent ministry. And the next step is for it to be drafted in legal terms by Office of Attorney General. And therefore, the process is now, as we speak, past the National Treasury, and thereafter it will be approved by Cabinet and therefore taken through parliamentary process. I think that's a process that is external to our operations, and we have done our bit, and hopefully within the course of next year, 2025, we'll be able to see that happening. But we cannot specifically say how long it will take for it to be enacted into law. But I'm sure it will not be long. That will be done within the course of next year.
Let me just flip this question around. At the moment, just for the sake of argument, at the moment, with the existing act in the way it is it possible for CAK to initiate an investigation, a market inquiry that would then lead to potential fines into these entities that may not necessarily have a legal presence in Kenya, especially with respect to digital platforms?
From our end, a market inquiry normally is what we do as research is to carry out a market inquiry. We would love to understand that particular sector, meaning that there will be little understanding or there's more information required for us to have an informed decision in terms of policy making, which will be one of the proposals that will come out. What it has pointed out is that there is a gap in terms of the law addressing the emerging areas of competition law enforcement. And therefore, the law will not be able to execute to finality that kind of a process. But market inquiry indeed identifies to us what is required and what are the gaps, and therefore inform the sort of amendment that we have just mentioned in incorporating those gaps in the law. Besides that, what is also important for us is to look at if a digital space or any sector issue is arising. I think there's also need to be conscious in terms of not to kill innovation, because innovation is one of the key components of competition. In the infancy stage of any development in any of the sectors, it's also good to be conscious in terms of not to kill innovations and also creativity that might be within those spaces. And therefore, I think the far we have come, and also looking at more mature jurisdictions like European Union and FTC of US, these market inquiries have been done, and therefore they have carried out investigations and they have penalized those companies. And I think we are just following those steps in terms of best practices, how these issues are being investigated and how they'll be executed to the finality. So what I can say is that, yes, there could be indication of digital practices, which are not big scale, but we need to, first of all, be having powers to execute those mandates within our law.
I want to turn into another thing that I've seen the competition authority has been doing, regulatory impact assessments, which, from my understanding, is essentially sitting back and asking, if we make law XYZ operational, what impact will this have on the market structure, on competition in this market, on the consumer, on the behavior of buyers within that market? These regulatory impact assessments, tell us exactly how they work. And are there any interesting examples you can share of CAK having put these RIAs, these regulatory impact assessments, into practice?
Yes, that's true. In terms of, we have done that both at the national government level and the county level. The way we have done it is that in all our activities, we prioritize sectors which are likely to have issues on competition, and also consider, because of other consideration of our operations on an annual basis, sectors which are likely to have more impact in the absence of competition on wider population. One of the ways that we are pursued in these issues is, one is to look at the county government and their operations. And over the years, we have reached out to different counties at different times, informing or educating the lawmakers at that level, the county assembly, what they need to know, so that those considerations in terms of the impact of the lawmaking process at that level, so that we get more compliance in drafting of the laws at the county level as well, beside the national government one. So those impact assessments will be useful for us to inform what sort of market structure will be developed as a result of those laws being enacted at the county level. So that's what we have done. And I think that will be very fruitful engagement, even though one of the challenges we have seen with the change of county government, then we also need to restart the process in terms of just informing the lawmaking process and how that will affect the market structure and how that might turn out to be anti-competitive. So that's what we have done. And it has been very intensive for us to reach out to them. And I think we have made good effort, as reflected by some of the counties coming to us in terms of providing advisory on their own draft laws for us to have input and review, see what competitive or anti-competitive practice or outcome might be incorporated in those laws and therefore need to be revised.
Who usually is responsible for triggering request for regulatory impact assessment? Is it like baked into some sort of government procedure that says, look, if you want to initiate a law that will effectively have some sort of impact on how the market structure operates, you then have to ask CAK for regulatory impact assessment? Or do you do it of your own volition? And once you've offered this advice, you put out an advisory, then what? Is there any way in which these public entities, either national government or county government, are bound to follow that advice? Or if they don't want to follow it, then they have to explicitly say in public, this is why we disagree with this assessment, and this is why we're going to go with this specific policy direction instead.
Yes, that can be potentially one of the challenges that we can encounter as a result of our advice, and therefore how the advice is taken or not taken. What we have done in the past, we have taken proactive position, especially at the national government level, all laws have to pass through public participation. And we have taken proactive position in terms of looking at what laws have been proposed and what are some of the issues raised in those clauses of the law, and therefore what are the possible anti-competitive issues that might need to be addressed on that level. In most of the cases, actually, we have seen that our recommendations have been taken, and therefore we have not cases where counties have come to us and we have not seen any anti-competitive behavior in their conduct. So what we have seen, therefore, is that to a large extent, we have made input and there's no requirement for any agency making law to come to us. But we have seen also instances where certain regulators have shared with us their regulations or in a consultative way asked us to be part of their team that makes certain revision of the law or regulation that inform that process. So it's a mixed bag. I cannot say it's one mode of engagement. So we have had different mode of engagement where they come to us or we propose and we have followed up and seen that it has been taken. May it be in the cultural sector, may it even be in the financial sector, may it be in the telecom sector. We have seen instances where these have been brought to us and we have responded to them. Even at the county level, we have seen laws that have been proposed to us and we have made our comment.
Are there any examples you can share with our listeners today on these RIAs actually translating into policies that people are familiar with?
One particular law that we have an input and it has been taken up most of our recommendation was the tea sector with regard to the governance structure. If I recall well, the governance structure of the tea sector without competition issues along the value chain, all the way from the farmers to the auction in Mombasa. We have looked at the entire value chain and also competition issues from the farmer to the transporters, all the way to the auction in Mombasa. And we have made proposal that there's a need to link certain resources, human resources across the value chain so that segment, particularly the authority, does not employ certain factory managers for that matter. So we have seen that being taken up very closely and we have followed up to see that actually that was amended. And therefore, some of the outcome we have seen from that is that there have been indication that has resulted in more earnings to the farmers across the country. And two, the other one is with regard to digital credit market that we did some time back in collaboration with the financial sector regulator, the Central Bank of Kenya. Our recommendation and also inquiry recommendation was taken up and that was incorporated in the amendment of the central bank in 2022. So that has been taken up very well also. And the impact is actually related to the question you raised earlier with regard to digital markets. And that informed the regulation of the digital lenders in Kenya.
And one of the things that stood out for me in that specific study, and I've just linked it in one of the pinned tweets under the space in case anyone's interested in reading that paper from May 2021, one of the things that stood out to me, and I've seen this coming up in other competition fora as well, is the question around how much data do we actually have to properly understand these new and emerging markets. So for example, in that 2021 study, one of the things that you said at this point was that in future, CAK may wish to request all digital credit providers to submit data on the number of active users, the overall loan value and the volumes in order to get a much better idea of what the market is like and to monitor things like market concentration, for example, on an ongoing basis. And that's just one example of it. I know in terms of e-commerce, that's also a bit of another issue. There's a lot of purchases that happens, for example, with respect to Amazon, deliveries that are done here. But in terms of actually getting more granular information on how much of this trade actually exists, how does it take place, that lack of data problem is always a tricky one to solve, isn't it?
Yes, that is true. And also there are issues around compliance with the privacy and issues. The amount of data that is generated is huge. And therefore, it might also require upscaling of the skills and also analytical skills in terms of how that data will be analyzed. And therefore, also, I think in that kind of situation, it's also good to have good collaboration, even when we are doing market inquiry or market study or sector study, where the information we gather are put together in a way that informs policy. And therefore, more cooperation will allow government agencies to come up with better policies, which are based on research and based on evidence that come up with a kind of decision that might lead later on to reform in sectors in the government. So it's true that data is becoming another gold in this time. and therefore cooperation view because of different and overlapping mandate of different agencies. Cooperation and collaboration will be key in terms of getting more sound policies in terms of digital and also big data in Kenya, just like any other jurisdictions. As you might know, also informed by that kind of challenge, the Competition and Market Authority of UK, based on digital platform and digital ecosystem inquiry, they were able to establish data unit within the organization, combining skills from economists, from statisticians, from ICT background, for them to look at a solid way of looking at data and analysis, and therefore look at both issues of competition as well as consumer welfare. I think this also speaks to a large extent in what the issues we have just discussed, how competition might provide solution to some extent on inequality or equality based on that kind of robust analysis. So I think moving forward, that is very important.
One last question for you, Dr. Rio, before I bring this to a close. How do we compel these foreign entities, who may not necessarily be domiciled here, but they've got a large amount of business that is taking place within the continent or within a specific country? How do we compel them to essentially provide some of that basic data that you would need for market surveillance? Should we essentially put that into law as part of the package of amendments that you mentioned a little earlier?
I think in compliance with the law, the Competition Act provides for data requests, provided data which are confidential or they're strategic to an undertaking, that they can ask for confidentiality requests that this data is confidential and therefore is not available in public domain. That kind of provision exists in law. Compelling them, the law also provides in the case that parties are not willing to provide that, provided the data is relevant for our jurisdiction. The law already provides for that. And therefore, the only additional thing that has come up in recent years is compliance with data protection law, and also the fact that data privacy, when it relates to individuals, might be something that needs to be very consciously handled. And therefore, compelling, I think, is already provided in the law. It's just enforcement, how companies are willing to cooperate in terms of providing data which are useful for policymaking. And also it relates to, in a way, the point you earlier made with regard to advocacy, that in terms of advocacy, in terms of research, if we carry out an inquiry and the outcome indicates some anti-competitive behavior, it's not going to follow the path of penalizing a company. It's just looking at remedial measures that are likely to correct that kind of competition. And therefore, multinationals within the Kenyan jurisdictions, they operate within our laws, but there could be having a parent company outside, but subsidiary here are governed by a competition or any other law that will be relevant for the operation in Kenya.
And I'd like to bring this session to a close. Hopefully we have got a better understanding of how the competition regulator works and the many challenges that they have to deal with in trying to essentially get this country to a much more fairer, more equitable market for us at the moment and hopefully 10, 20, 30 years down the line. Mugambi, any AOBs that we need to put on the table for our listeners today?
Maybe I just give a wrap in terms of the topic. The whole point, and maybe the economists here, the whole point of competition law enforcement, we're not the silver bullet to end inequality in the world. But competition law enforcement have been touted as one of, maybe it's to a small extent, but it's one of the solutions of ending inequality. So basically inequality, which is not the same as poverty, but interlinked. So the issues to do with opportunity. And I think that's what inequality in terms of opportunity. And that's what Dr. Adano has really talked about in terms of players being allowed to access the market. You as a consumer, as Rama, being allowed or having the opportunity to select goods or services that suit you, that meet your needs, evolving needs. There's an element of inequality when it comes to income. Again, what we do on a daily basis sometimes unintentionally affects inequality when it comes to income. So you'll find issues to do with merger regulation. For some instances, conditions that entities that are merging should not let go of employees beyond a certain limit or a certain sunset period. So that it's not our main or intention, but we salvage incomes in such instances. There are unintended outcomes of competition law enforcement from our end, but the take home is that we are just one of the solutions. I'm sure you can think of others, including taxing the wealthy and all that could bridge the gap between the haves and the have-nots. So with that, I'd just like to go back to the initial, when I was beginning the spaces event. So as I said, we are at CBK Pension Towers. We've been around for around 13 years. If you want to contact us, you can contact us via email, info@cak.go.ke, info@cak.go.ke. If you want to lodge a complaint, for instance, if you come across something that could constitute uncompetitive conduct, you can reach out to us. You can either submit it via the known emails, but we also have other channels where if you want to submit anonymously, you want to engage us anonymously, we even have a reward scheme. If you snitch, for lack of a better word, if you snitch on someone and we end up busting a cartel or something and we penalize them, we'll give you a fraction of that penalty up to $1 million bob. You can contact us by a phone call, 254-20-277-9000. Unfortunately, we are domiciled in Nairobi, physically, as I said, on CBK Pension Tower, but you can access our services from across the country. If you go to our website, www.cak.go.ke, www.cak.go.ke, under the e-services tab, you'll find an e-filing portal there. So that's the portal that is used for all our services, all the technical services. We more or less do not accept paperwork here. The minimal paperwork that is received is converted immediately to digital format. So if you want to lodge a complaint about anything, if you want to speak to us, use the portal. Consumer complaints, again, just submit them there. Take photos of your receipts, your warranties, and everything else. We'll give you a narrative, then we'll process it for you. And lastly, these services are offered free of charge. At some point, I mentioned the merger filing fees. So unless you're a merging party that has a combined turnover of 1 billion and above, everything else that we offer at CAK is free of charge. Everything else we offer at CAK is free of charge, except merging parties that have hit that threshold, and then they pay $1 million bob. Consumer complaints, will do it for free. If you lodge a complaint about an uncompetitive conduct or abuse of buyer power, we'll do it for free. So if you see information out there that says to the contrary, just know it's not true. We offer the services free of charge. So thank you again, Rama, Eric, and as always, Daktari, for being a good sport and doing this late into the night.
Indeed, it's a Friday night, and especially in December, time is very tight. There are many things competing for our time and our attention at this point in time. So I can't say thank you enough to all of you, to Dr. Adana Wario, Mugami Mutegi, of course, from the Competition Authority of Kenya, and of course to you, our listeners who've been with us. Thank you very much for your time. Have a great evening. We'll see you in the next one.
Thank you very much, Rama, and your team and the audience.